In this video, we're going to talk about one of the most common loss contingencies example, that is product warranties. Now, most consumer products are nowadays accompanied by a guarantee, and we actually learned the two types of warranties in revenue recognition chapter, quality assurance warranty, that is not a performance obligation, right? And we also learned about the extended warranties. So extended warranties is one of the performance obligations. We first talk about the quality assurance warranty first. Now, seller offer a quality assurance warranty in order to boost sales. But then it follows that any cost of making the good on such qualities, fixing it, replacing your goods, right? These costs should be estimated and recorded as expenses in the same accounting period, right? Why is it the same accounting period when you sell the product? Because of matching principle. You have to match the expense with the revenues. While also it is the period of sale that the company becomes obligated or liable to eventually make the, fixing the goods or replacing the goods because you have this warranty. So it makes sense that companies recognize a liability in the period of sale. Now, there is a challenge along, that is how much of cost, how much should we recognize? How do you know the future cost, in terms of fixing or replacing the goods? So then think about it. Uh, is it a loss contingency or not? Well, we talk about the table of loss contingency. That is this one, right? We know that the likelihood is probable. You have the prior experience about how much, the loss contingency is. And, once you provide a warranty, there gotta be some fixing and, because your product is not always perfect, right? And the second challenge is the dollar amount here, right? Do we know the dollar amount of the future fixing, replacing, or is it reasonably estimatable? It seems to be reasonably estimatable. Why? Well, although we don't know for an individual product how much the price is, but we have an estimate of the total number based on the prior experience. We have sold these products before, or according to the industry kind of rules, industry practice, maybe about 7% of the products will have problems. And then our warranty needs to be kind of applied to these problematic goods. And then there's also kind of prior experience on how much we're going to fix it. So you use the 7% times the total fixing number, right? So overall, it can be satisfied as a loss contingency. Now, how are we gonna do the accounting about these product warranties? Let's use an example. So this is a chair selling company. The warranty is a 2-year warranty. Estimates based on industry experience indicate that warranty costs of 3% of sales during the first 12 months, and then 4% of the next 12 months. During December 2021, its first month of availability, the company sold $2 million of chairs. First of all, we gotta record the selling of chairs. We've learned it pretty straightforward. We debit either cash or accounts receivable for 2 million, and then we credit sales revenue. Now, when it comes to the end of the year, we're gonna talk also kind of adjust entries for the warranties. We talk about that this is the cost associated of selling the goods, the chair, and then we also have to recognize a liability, which is the obligation of providing, fixing, and replacing the chairs in the future. So liability and expense. So debit warranty expense and then credit warranty liabilities. How about the number, the amount? So we use the total percentage, which is 3% in the first 12 months and 4% in the next 12 months. 7 in total times the total sales number, which is 2 million, we got $140,000. So when customer claims are made and costs are incurred to satisfy those claims, we will reduce the liabilities. Now let's assume that the actual cost is $61,000. This is an assumption in the question, right? Let's assume in 2022, it happens that $61,000 are paid out for the warranty. Now then we need to sort of reduce this liability because we fulfilled the obligation. So that obligation should reduce. What should we do? We're gonna debit warranty liability to reduce it. And then we're gonna credit whatever necessary. It may be paying out cash for the return. We may also hire someone to fix the chairs so that the salaries payable. And maybe we need to replace some parts of the chair, etc. So these are the assets that is gonna be credited, which means it's reduced. Now, that was the quality assurance warranty. Now, this is the extended warranty. And extended warranty, we are pretty familiar with it. The definition is that this warranty provides protection beyond the manufacturer's original warranty, right? So think about the procedure. Well, of course, it constitutes of a separate performance obligation. And then are we able to recognize revenue right away? Not necessarily. Although we received cash when the warranty was purchased the same time when they purchased the good, but this extended warranty, it provides coverage over a period of time, right? So these arrangements typically qualify for revenue recognition also over the period of coverage. So it is pretty similar to the magazine subscription in that sense, isn't it? Now, then we need to recognize revenue, evenly. This is also the assumption, straight line basis. Let's look at an example how to demonstrate the accounting of extended warranty. So customer are offered the opportunity at the time of purchase to buy a 3-year extended warranty. On January the 1st, they sold a $60 extended warranty covering 3 years. So 2022, 23, and 24. So when the extended warranty is purchased, we're gonna do the following. We receive $6 cash or not. So if not, then we're gonna debit accounts receivable. And we have a deferred revenue. It is extended warranties credited for $60. And then remember, we're gonna record evenly on a straight line basis over the period of coverage. That is 2022, 23, and 24. So 3 years. And in total is 60. 60 divided by 3 is $20 per year. So we're gonna reduce the deferred revenue liability by $20. And we do debit deferred revenue. And we're gonna credit revenue because at that time we are entitled to recognize this revenue. A quick concept check. The answer here is $10. Now, next, we're going to talk about the disclosure of litigation contingencies.